Hello, welcome to Advanced Taxation class. I'll be talking about the personal income tax computation. We'll be looking into the computation aspect of personal income tax. And we'll look at the taxable and non-taxable income classification, the relief, allowances, and deductions for individuals. We'll look at consolidation of multiple income sources, and computation of accessible total and chargeable income. And lastly, we look at administration compliance to payee and direct assessments. This module provides an in-depth explanation of the principles and technical procedures involved in accurately computing personal income tax and in modern tax system, and with particular reference to the Nigerian context. And as individuals increasingly earn income from diverse sources, such as the employment, business, investment, property, and professional activities, the need for a structured and comprehensive approach to personal income tax computation becomes essential for both taxpayers and tax administrators. First, we need to understand what are the things that are taxable, which deals with the classification of income, the incomes that are taxable. The first one is dealing with employment. The first classification is dealing with employment, and these include the salaries, the bonuses, allowances, benefits in kinds, in terms of company car and the likes. And then for business segments or professional classification, the taxable income include the profit from trade, vocation, and professions. And under the investments, the taxable income include dividend, interest, rent, royalty, and others include the casual winning, commissions, and the likes. And non-taxable income include statutory exemptions, as we see them, for example, certain compensation for injury, and another is the non-income receipts, like gifts, inheritances, and the likes. And lastly, specific government incentive based on exemptions, specific government incentive based on exemptions. And here, what is very important here is accurate classification is critical for fairness and compliance. Looking at relief and deduction, it's actually a means of reducing the tax burden, and the purpose is to adjust gross income to reflect personal circumstances and promote policy goals. And example is savings, charity, and the likes. And the consolidated relief allowance, to calculate this, it's actually the higher of 200,000 naira or 1% of gross income plus 20% of gross income. And universal relief, it's actually a universal relief to protect low-income earners and ensure equity. And other key allowable deductions are pension contributions, which is 8%, and another is the National Housing Fund, the life assurance premium, and also approved donations. These are allowable deductions. Then we have a step-by-step process of doing this, and the first is identification and classification of all income streams. And the next is to aggregate all taxable income to find total accessible income. And the next is to apply deductions. There is pension, the NHF, the CRA, and the likes to find the total income. And the total income is actually the same thing as the chargeable income. And the next is to apply progressive tax rates to the chargeable income. And last, you deduct withholding tax credits to find the final tax payable. Looking at it, the aggregating of income sources, Why do you have to do that? Why do you have to consolidate that? It is to reflect the true economic capacity and ensure progressive tax rates are applied correctly. And to calculate this, you calculate income from each sources separately, then sum it up. For example, an aggregation is employment income now, having a 3.5 million, business income having about 1.5 million, and investment income having about 550,000. And the total accessible income is actually 5,550,000 naira. And since we've gotten the 5,550,000 naira now, we need to deductions are applied after consolidations of all income. And we have the likes of the pension, the NHF, the life assurance, and then with that, to be able to calculate the CRA, it's actually the 20%, 200,000 plus 20% of 5,550,000. And then we have 1,310,000 naira. And looking at the total deduction is actually 1,734,000. 1,734,000. When you had the pension, the NHF, the life assurance, and the CRA together, it gives you a sum of 1,734,000 naira. And this is actually to calculate the chargeable income now. You have to do the you get the TAI minus the total deduction, the total accessible income minus the total deduction, and you get the 3.816 million, 3,816,000, 3,816,000, and that is the chargeable income. Now, for you to calculate the tax liability, we have the rate, progressive rate that are used in calculating this. And in doing this, we have it as stated there. And we have a 7% for 300,000, 11% for 300,000, and the next 300,000, 15% for the next 500,000, 19% for the next 500,000, 21% for the next 1.6 million, and we also have another which is above 3.2 million, and that is 24%. So for the purpose of this calculation, after it has gotten to 1.6 million, which is charged at 21%, then the balance would be 616,000, which was charged on 24%. And that gives a total computed tax of 707,840 naira, as you've seen. And how is PIT calculated in terms of payee versus direct assessment? And the payee, this is actually for employees. Tax is deducted at source by the employer and remitted monthly, and this ensures steady revenue and simplifies compliance for employees. And for direct assessment, it's actually for self-employed people like business owners, freelancers, professionals, and the likes. And taxpayers declare income directly to the tax authority via self-assessment under this. And it requires proper bookkeeping and annual filing in doing that. In conclusion, consolidation is mandatory for an accurate tax base, and the CRA is a fundamental non-discretionary relief. The step-by-step computation process is sequential and logical from what you've seen, and understanding the distinction between payee and direct assessment is crucial for compliance. Thank you.